Hi, everybody. This is Alan Ellman, the Blue Collar Investor, welcoming you to this BCI podcast number 99, The Anatomy of a Reverse Stock Split. We're going to be using a real-life example with Spider S&P Oil and Gas Exploration and Production ETF, which trades on the New York Stock Exchange under the ticker symbol XOP. Now, there are two categories of option contracts. They could be either standard, the ones we're most familiar with that deliver 100 shares of the underlying security, or they can be adjusted. Now, adjusted contracts are normally the result of various corporate events that may change standard contracts to adjusted contracts. Some of those events include stock splits, mergers and acquisitions, special one-time dividends, spin-offs, and the topic of this podcast, reverse stock splits. Now, when these events take place, the options are altered to reflect the changes from these corporate events, and that will be fair to buyers and sellers of calls and puts, as they will be made whole as a result of these option contract adjustments. So there is no free lunch, nobody benefits, and nobody loses. Let's focus next on specifically the reverse stock split. This is where there's a reduction in the number of outstanding shares, but an increase in the price of the underlying security. So the holder of an options contract, calls or puts, will have the same number of contracts, but there'll be an increase in the strike price based on that reverse split value. But the number of shares deliverable will decrease by that split ratio. That'll become more apparent as we show you the real life example with XOP. Now, the contract will now result in that reduced number of shares based on the reverse split value. So why do corporate boards approve these reverse splits? Well, just picture the price of a stock declining precipitously. A lot of investors may view this now as a low quality security. They may not want to participate in purchasing shares. So the reverse split will actually increase the share price, even though it's simply a cosmetic improvement. It doesn't actually change at all the total value of the shares. So companies may also fear exchange delisting, because many of the major exchanges will have a certain minimum price requirement for those securities, and they don't want to be delisted, which will also impact how investors view that particular stock or exchange traded fund. So in essence, it's a cosmetic change. Now let's focus in on a real life example with XOP, which started at the very end of the calendar year 2019 into the beginning of 2020. Now, for those of you who are also watching this podcast, you could see from the price chart that from December 2019 into January and early in the year 2020, the price of XOP declined from 100 down to $30 a share. What a precipitous decline. So the corporate board voted on a 1-for-4 reverse stock split, which will then quadruple the price of XOP, but decrease the number of shares. So in essence, the actual capitalization remains precisely the same. Once again, it's just a cosmetic change. Now, when the Options Clearing Corporation, or OCC, published this change, I actually have a screenshot of that now for those watching this podcast. You could see the following. The price of the shares quadrupled. The number of shares deliverable from these options contract is quartered. So options buyers and sellers of calls and puts do remain whole. The ticker symbol of XOP during this transition did change from XOP to XOP2D. So when trading options for the period of time of transition until all of the older options contracts that were adjusted are gone, the actual ticker symbol will change. And the number of shares deliverable, once again, is quartered. So let's do an overview of a reverse stock split. They are generally signs of weakness. When a price declines precipitously, as did XOP, something's up in terms of the fundamentals of the company. Bad news has come out, or there was a very negative earnings report, or something in the overall market makes the industry that that particular security is in look quite weak. Now, these corporate events, the reverse stock split, enhance the cosmetics of the share price without changing the overall value of the security. It's important to know. It's not like you get a windfall because the price quadrupled. No, the number of shares is quartered. Option sellers and buyers are made whole by the Options Clearing Corporation by altering one or more of the contract parameters. In the case of XOP, the number of shares were reduced by that factor of 4, while the price of the stock increased by that factor of 4. And for those holding options, the strike price is quadrupled as well. Now, generally speaking, because reverse stock splits are a sign of weakness, these securities are not the ideal candidates for covered call writing and selling cash secured puts. But if this type of thing does happen to you and you hold these contracts and you're wondering, what happened to my strike price? Why is the ticker symbol different? Hopefully, this podcast will be helpful in understanding what's taking place. So before I leave, I want to remind everybody about the BCI package, something we're very, very proud of. It's an acronym for our best and most comprehensive investment package ever offered by the blue collar investor. It includes 6 online video courses with downloadable workbooks, 6 of our best calculators found nowhere else because we created them, and 5 of our best selling books in ebook format, as well as an annual premium membership, which is 13 months of receiving our reports for the elite performing securities eligible for short-term option selling, as well as a huge educational component, including 200 educational videos, expanded calculators, and many files and resources available only to our premium members. And this package is offered at a 20% discount for $997. It includes everything and anything you will need to master the strategies of options selling. The link for the BCI package for more information, including an explanation that we do in video format, is located on our website, www.thebluecollarinvestor.com. Just look for the link that says BCI package. For those watching this podcast, it's circled on the screenshot. Ladies and gentlemen, I want to thank you so much for taking the time to listen to this BCI podcast, number 99, Anatomy of a Reverse Stock Split. I hope you enjoyed this presentation, and most importantly, I hope it puts cash in your pockets. As always, this is Alan Ellman, the Blue Collar Investor. Take care, everybody.